Hi, this is Tim Cantrell. I'm the Principal Investment Advisor and Certified Financial Planner here at Applied Capital Nashville. I want to tell you a story about a client of mine. Let's call him James. James is single and turned 50 last year. He is concerned about his taxes and ability to save for retirement. James recently switched careers and lost his ability to save through his employer-sponsored retirement account. He has been a good saver up to this point. James is now a sales consultant making around $260,000 a year. He does not have any employees and is considered an independent contractor, so he receives a 1099 at the end of the year. He loves his work, does a great job, but his tax obligation at the end of the year was like a gut punch. The first time we sat down, he told me, "I feel like I work for the IRS. They're taking nearly half of my income in taxes." When I ran my analysis, James's actual marginal tax rate was over 65%. And James is not alone. If you're a self-employed high earner, whether you're a consultant, freelancer, real estate agent, or a doctor running your own practice, you may be in the same situation. But here's the thing, I showed James one simple strategy, and it saved him over $25,000 in the first tax year alone, and it put him back on track for retirement. Want to know what we did? Stick around, because I'm going to walk you through exactly how this works and how you can do it as well. So here's what was happening with James. He made $260,000 for the year as a 1099 consultant. Since he does not have an employer, no one was withholding taxes, so James was filing estimated quarterly taxes, but it was not enough. He had savings from a prior employer, but was going to use deductible contributions to a traditional IRA for his retirement savings. He did not feel that that was going to be enough for retirement. James did not realize that he could form his own employer-based account, so I stepped him through the differences between a simple IRA, a SEP IRA, and an individual 401k. I used our tax planning software to illustrate the differences between the three accounts. Okay, so on my computer, you should be able to see the four different scenarios that we ran for James. On the left-hand side, you have if we do not use a retirement plan, then there's the simple IRA, the SEP IRA, and the individual 401k. From an income standpoint, we left the income at $260,000 just to make it easy to see the differences between the four plans. You do have a deduction here that jumps in. This is the employer side of your self-employment tax. That's considered a deduction. But when you look at the self-employed plans, you can see the maximum contribution amounts to the different types of plans. So you have a simple IRA, which is $27,000, the SEP IRA, $49,120, all the way up to the individual 401k, which he actually hits the max. That's the maximum contribution amount that you can make of $77,500. So he actually caps there. When you add those two deductions together, you can see now you're at $14,400 for if you're not using a retirement plan, all the way over to $91,900 with the individual 401k, which drops your adjusted gross income down to $245,000 under the starting scenario, all the way down to $168,100 if you're using the individual 401k, again, maxing it out. Since James is single, we used a $15,000 standard deduction across all four scenarios. What's really interesting here is that James is in the QBI phase out range. So if he's not using a retirement plan, his QBI deduction is $16,406. But just with the contributions to the simple IRA, his QBI deduction jumps up to $38,353. And then you can see it actually goes down with contributions to the SEP IRA and to the individual 401k, but that's because his taxable income has dropped because of the pre-tax contribution. So those numbers are intertwined. But you can see the net taxable income at $214,000 all the way down to $122,480 using the individual 401k. So that leads us to a total tax amount maximum of $76,498. This is if we don't do anything, dropping all the way to $51,403 if we use an individual 401k. So that's a $25,000 drop in the tax bill that he has for that year. From a marginal tax bracket standpoint, he's at 32%, dropping into the 24% marginal tax bracket. But that really does not tell the story. When you look at his effective tax, that tax on the last dollar that he made, he's actually at 67.2%. By making the contribution to the simple IRA, that drops to 48.8%. And again, the reason it is so high is because you're repealing the QBI deduction, and it's done over a relatively short income range. So the marginal tax rate, the effective tax rate is very, very high if you're in that range. So it's 67.2, dropping all the way to 19.2. Now, if you recall, he's in a 24% marginal tax bracket. The difference between 24% and 19.2 is the 20% QBI deduction. That's just the way the QBI works. So the QBI actually reduces the benefit of contributing to a pre-tax account. After showing James the difference between the accounts, he was very excited to get started. He actually stood up and shook my hand and said, "I'm in. How do we get going?" So I stepped him through the benefits of the accounts, and we agreed that an individual 401k would be the most flexible option. As such, I outlined the process for opening an account. The first step is to complete a 401k plan adoption agreement. Since James does not have any employees, we used a simplified plan adoption agreement signed via DocuSign. The form is a template provided by third-party custodians. Some custodians charge a periodic fee for the form. However, we were able to utilize a plan adoption agreement at no charge from one of our custodians. The next step was to upload the form into a digital workflow with the custodian. Once uploaded, we were able to release the workflow for a digital signature. After about an hour, James's new individual 401k account was open. At that time, James was able to use the custodian's digital interface to connect his bank account. The connection took a couple minutes to process. Once the bank was connected, we were able to draft funds into James's account and fully fund the prior tax year. We also prepared a tax letter for James to provide his tax preparer. The letter explained to the tax preparer the contributions that we had made. The entire process took about an hour and a half to set up. James was able to make a $23,500 employee deferral contribution on a pre-tax basis. He was also able to make a $7,500 employee deferral catch-up contribution since he turned 50 last year. Additionally, he was able to make an employer matching contribution of $46,500 on a pre-tax basis. The $46,500 was just shy of the 20% employer contribution maximum. However, he was limited by the total defined contribution limit of $77,500. We discussed James's ability to make the $46,500 contribution on an after-tax basis. The after-tax contribution could have allowed James to contribute a large sum to an account that could be converted to a Roth K or tax-free account. However, due to the QBI phase-out, we recommended James not do so since his marginal tax rate is expected to be lower while he's in retirement than it would have been today. We did discuss the possibility of James getting married. As such, his marginal tax rate would be cut and he would no longer be subject to the QBI phase-out. At that time, we would need to seriously consider using an after-tax contribution option for his 401k contributions. Our initial discussion was solely around federal income taxes. However, if James lived in a state with income taxes, his marginal tax rates and the corresponding tax rates would have been even higher. If you fast forward 15 years, if James keeps maxing his individual 401k, his contributions alone will add up to over $1.1 million. Assuming just a modest 7% growth rate, his balance could top $2 million before he reaches age 65. James will be able to retire on time. After we set up James's individual 401k, he called me and said, "Why didn't I do this sooner?" That's the question I hear all the time. Most high-earning 1099 professionals are either not aware of the strategy or they assume setting up a plan is too complicated. But here's the truth. It's actually pretty easy when you have someone guiding you. So if you're making $200, $300, even more as a self-employed professional, here's what you need to do. First, set up an individual 401k. I can help you pick the best provider. You should be able to set up the account at no cost. Some third-party custodians provide a simplified plan adoption agreement at no cost. Decide how much to contribute. Decide whether you should make a pre-tax, post-tax, or a combination of pre- and post-tax contributions. Make your employer and employee deferral contributions for the deadline. You have until the tax filing deadline plus any applicable filing extensions to make the contributions. So in James's case, he had filed an extension, so he had until October 15th to make his prior year contributions. Then start investing and watch your money grow. And be sure to file Form 5500EZ when your 401k balance exceeds $250,000. This is an informational form and does not impact your tax obligation. Here's the deal. James figured this out in time, but most people don't. In every year that passes without setting up the right plan is tens of thousands of dollars lost to tax taxes that could have gone into your future wealth. So if this sounds like you and you're wondering, how much should I contribute? Should I choose pre-tax, Roth K, or after-tax contributions? Or what's the best investment strategy for my 401k? Well, let's talk. We offer complimentary introductory meetings. During the meeting, we will go over your specific situation and build a plan that works for you. Just click the link below, schedule a time, and let's make sure you're keeping more of your hard-earned money. And if you found this video helpful, just do me a favor. Hit that like button, subscribe for more tax saving strategies, and share this with a fellow 1099 professional who needs it.